now with us. Digant, thanks so much for taking out time for us. Let's start with NBFCs, Digant. I mean, that's something which you've been tracking, really for a long time. You think that, if there is any sense that rates in the system are peaking out, you think NBFCs will be the first one to benefit because they've not done as well as banks? Then you had the entire IL&FS issue where, NBFCs were forced to change their liability and asset models. How do you see the sector placed now?
Hi, thanks for having me here. Uh, See, I think the rates peaking out because of whatever happens globally. See, the rates, there are two ways in which the rates can peak out. One is that, we break the back of inflation and then the rates peak out. So that is a, very good setup for a big macro rally in the economy as well as in NBFCs. But here, we are seeing a little bit of, peaking out of rate because I think there is a sort of demand destruction kind of a scenario globally. What happened in the US with the banking system, and now it's spread to the Europe. So I think this rate reduction is largely to do with a demand destruction or a softer demand kind of a scenario. So I think no, it's a little early to celebrate and say that NBFCs will just start doing well because see the rates fine. The rates are going to probably peak out or maybe they'll start declining say 6 months down the line. But the point is what happens to the demand. What happens to the end consumer segments. So in NBFCs the largest segment is the housing finance companies. Housing finance companies, at 9%, 9.5% kind of home loan rates, you're not going to see a massive growth. The premium end of the housing will still do well, but those customers take loans from banks and not really from the housing finance companies. Second, you come to CV finance companies. I think that is one bright spot because the underlying demand is very strong. The resale rates of the vehicles are quite high because of the inflation, and the cash flows are good. So I think this is one segment where I would really stick out my neck and say that in the next 12 months you can look at good positive returns in this sector. And third is microfinance. Microfinance is again where it's in its own world, and the demand is really started picking up. So that's one sector where you will see 25% kind of growth. But apart from these two, commercial vehicles and microfinance, I think it's a struggle. Consumer finance will struggle, gold finance will struggle, housing finance will struggle. So I think you have to pick and choose. It's bottoms up, even in the NBFC sector, not just like the whole sector rallying together.
Need to be stock specific when it comes to NBFCs as well. But Digant, I wonder if you have looked at the latest announcement coming in from Paytm regarding the interoperability, because they have announced that Paytm wallet is now universally acceptable on all UPI QRs and online merchants, as NPCI has announced that KYC wallet interoperability is now completed. Do you think that could materially change the fate of Paytm and overall your outlook as far as that stock is concerned?
See, I think incrementally it's, see the Paytm's payment business was always a loss-making business or at best a break-even business because that was the business which they used to recruit users like you and me and all the merchants, the kirana shops and the vegetable vendors and a lot of other merchants who do small-time businesses. So this business was always, thought of as, you get people on your platform and then you try to cross-sell something to them and cross sell, I think Paytm, the only thing they've successfully cross sold is the loans. They've been successful at cross selling loans, the buy now, pay later kind of consumption loans, and the merchant loans. So I think this interoperability, what it does is, it just increases the probability of customers sticking more to your platform. And once the customers stick more to your platform, you can cross sell them a little more. So I think in that sense, it is incrementally positive for Paytm. Uh, but I think that the model still has a lot to evolve. All these new age companies, they really may or may not be fully compliant with what the RBI guidelines around lending and partnership with other NBFCs and banks are. So I think incrementally yes, positive, but not something that we will just go gaga over as yet.
Okay, wait and watch and see what impact does it have. But yes, incremental positive coming in for Paytm. But let's shift focus and talk about the power companies because there was China plus one earlier. Now there's Europe plus one, and it seems like a lot of these export orders are coming India's way, especially in specialty chemicals.
We see we're tracking it only in terms of the top down as to when the pricing erosion stops and see, like we had a euphoria in the chemical sector in the last 3 4 years. The margins expanded. A lot of players announced capex, and now suddenly there's a slowdown in demand across the world. So I think this sector is best left to its own. Let it fight its own battle, and I think it's another maybe 6 months, so to say, before the stocks and the businesses bottom out. So I think we are watching this space, but not like we're just very very gaga over the space right now, because I think it's rallied, like most of the stocks rallied 5 to 10x between 2018 to 21. And I think after such a rally, and when there's capex and demand is slow, we see years of sideways consolidation. So I think the down journey is probably over in many stocks, but the sideways consolidation will still be there. So we've not, like done a lot of bottoms up work on the sector. Let the top down settle first, and then we'll get into action in this sector.
Right. Let's now go across.
What about the metal sector? Digant, what's your take? Because yesterday there was a note coming in from BofA. They were quite positive when it comes to metals as a whole. As well as today, Vedanta will be in focus on account of the fifth interim dividend announcement as well. Any top bets here?
See, in the metal sector, we were, in the past, China had always been like a big driver for the metal demand across the world. Uh, See, I think China has opened up, so we will see some good demand coming from that for say the next 9 to 10 months. But let me tell you that uh, Chinese economy was actually slowing down even before these lockdowns. So while maybe 6 9 months look great for the metal sector in general, beyond that we will face the same problem of a high base, like what we are seeing in a lot of other consumer companies in India. That once you made a high base of the post-COVID opening, it's very difficult to grow at say even 7 8% for these companies. So I think metals. But what is different this time is that see, most of the balance sheets are completely light. They're not as levered as in the past. So I think in metals there are pockets of opportunities which are definitely there. I think Tata Steel is our top pick because they have delevered the balance sheets quite well, and their chorus operations is the only one that that is a thorn in the overall investment argument. But I think the domestic part of metals is absolutely quite strong. And Anisha, in this metal space, we are more bullish on the ancillary metal plays. So ancillary metal plays like say an RHI, which gives a refractory material which is used in the blast furnace, or something like a Foseco, which gives you chemicals to make good metal castings. These castings are used in say an automobile sector and so on. So in the metal space, we are not directly wanting to play the actual metal stocks, because globally our view is that globally we are entering a period of moderate to slower growth only, and which is why the pure metal companies will find it difficult to beat the profits that we saw in 2021. And hence we are playing more on the ancillary part of the metal sector, which is the castings and consumables which are used in the metal making process.
Right. So metals look interesting from a 3 6 months perspective, but once again, as just things are opening up, he's saying that one needs to wait and watch on the developments as well. Let's go across to
Let's talk about some of the other stocks which are going to be in focus, and one of them is going to be Kalyan Jewelers. There's a big block deal which is expected. There's a 2.6 crore share or 2.5% of equity which will come into the markets today because it's expected Warburg Pincus is going to offload some shares, and the floor price has been decided at 110, which means at a discount of almost 7.5 rupees to the current market price. So there might be a bit of a downtick there, and Warburg Pincus currently holds 26% stake. And that tells you that there might be incremental supply pressure coming in for that one as well. Digant, not sure if you track this one closely, but if you look at even Titan and the other, consumer discretionary names, etc., they haven't been doing, very well. There have been a lot of sideways move at best. Your take?
Yeah, see, we saw very big pent-up demand in 2022. When the after we reopened for COVID, the marriage season was in full swing, and because people were not calling a lot of guests, like someone who would call 1,000 guests were just, calling 200 guests, and the incremental money saved was actually being spent in the jewelry. So in fact, Titan and Kalyan and everybody told us on their con calls and analyst interactions that the ticket size has actually gone up. See, so now you really have made a very high base for yourself in the last 12 or 15 months. It's very difficult that you will beat this base so easily, because now we are in a normal world where things revert back to the pre-COVID days, and then this excess spending which was there on gold, I think the next 12 months we'll see some bit of demand which will normalize. I would not say a demand slowdown, but demand which will normalize. And the second thing is that, see, we as Indians, whenever the gold prices really shoot up, we just postpone our purchases of gold, because now the gold prices are touching, say, 59, 60,000 rupees for 10 grams. So this also plays with the mind of consumer that, okay, prices have just shot up, let's wait, let it cool off, or so on. So I think there are multiple headwinds for this sector, or not headwinds, but I would say that next 12 months will be slow. And someone like a Titan who is keeping on experimenting with new formats, new local jewelry, going deepening down its distribution, I think they may still be able to show some bit of positive growth, not something like 20% plus, which they showed last year, but more between 10% to 15% kind of growth. I think someone like a Kalyan would probably struggle a little more, because they do not have the regional expertise, or the deep presence which Titan has, the multiple store formats which Titan has. So I think everybody will struggle. Titan will struggle less. Kalyan will struggle a little more, and maybe the Joy Alukas and the others will struggle even more. So yeah, in this sector we are more positive on Titan, but that too is a year of consolidation ahead for them.
Right. So Titan is the one to watch out for, but again, after a consolidation that one can see, we're just about the